Right now, silver traders around the world are looking at 3 different numbers, and all 3 are telling a slightly different story. If you open one platform, you see one price. If you check futures, you see another. If you try to buy physical silver, you see something higher still. So before Wednesday's silver opening, the real question is simple but critical. Which silver price is actually the right one? Tonight, we are breaking this down clearly, calmly, and factually. No hype, no conspiracy framing, just structure, liquidity, positioning, and what matters heading into the next session. As of the latest close, spot silver is hovering near recent consolidation levels after a volatile stretch that saw aggressive intraday swings. Futures contracts on the front month are trading at a slight premium to spot, reflecting short-term expectations and positioning ahead of key macro data releases. Meanwhile, retail premiums in the physical market remain elevated compared to historical averages, even as wholesale liquidity appears stable. So why are there multiple silver prices in the first place? First, there's the spot price. This is the over-the-counter reference price used globally, derived from interbank transactions and large institutional flows. It reflects real-time trading between bullion banks, market makers, and major participants. Second, there's the futures price, primarily traded on exchanges such as the COMEX division of the CME Group. Futures represent standardized contracts for delivery at a specific time in the future. They embed expectations, hedging activity, and speculative positioning. Third, there's the physical retail price. This includes fabrication costs, distribution margins, and local supply-demand imbalances. When retail demand surges, this price can diverge significantly from the paper benchmark. Heading into Wednesday's open, the divergence between these 3 is not extreme, but it is meaningful. The spread between front-month futures and spot suggests a mild contango structure, meaning future delivery is priced slightly higher than immediate settlement. That usually reflects stable financing conditions rather than stress. However, the more interesting development is in positioning data. The latest Commitment of Traders report shows managed money exposure has increased modestly over recent weeks, while commercial hedgers have slightly expanded their short positioning. This is typical behavior during rallies. Speculators chase momentum, while producers and bullion banks hedge forward production or inventory. The key question is whether this positioning is crowded. At the moment, net speculative length is elevated compared to the quarterly average, but it is not yet at historical extremes. That suggests silver is not in a euphoric blow-off phase. Instead, it appears to be in a tactical battleground zone where both bulls and bears have arguments. Let's talk about the macro backdrop heading into Wednesday. The US dollar index has been relatively firm, reflecting resilient economic data and steady treasury yields. A stronger dollar typically creates headwinds for precious metals, including silver, because it makes them more expensive in foreign currency terms. At the same time, real yields remain a central driver. When real yields rise, silver tends to struggle. When they fall, silver often finds support. Recent bond market movements have been choppy but contained. There has been no disorderly spike in yields, and inflation expectations remain anchored within recent ranges. That reduces the probability of a sudden volatility event at the open, unless unexpected data hits the wires. Industrial demand is another pillar. Silver is not just a monetary metal, it is also a critical industrial input, especially in solar panel production, electronics, and advanced manufacturing. Recent data from global manufacturing surveys show mixed signals. Some regions are stabilizing while others remain soft. That creates cross-currents in demand expectations. But here is where nuance matters. Short-term price action into Wednesday will not be driven by long-term industrial fundamentals. It will be driven by liquidity flows, options positioning, and how futures traders respond to overnight moves in currencies and bonds. Looking at technical structure, silver is currently trading within a defined range that has acted as both resistance and support over the past several sessions. The upper boundary has attracted profit-taking, while dips toward the lower band have seen buyers step in. This suggests accumulation rather than distribution, but confirmation requires a clean breakout on volume. Volume trends themselves have been interesting. During the last upward push, volume expanded moderately, indicating participation. During pullbacks, volume has not spiked aggressively, which suggests selling pressure has not been panic-driven. That is typically constructive, but markets can shift quickly if catalysts emerge. Now let's address the psychological component. When traders see different silver prices across platforms, confusion can create hesitation. Hesitation can reduce liquidity. Reduced liquidity can amplify volatility. So even small discrepancies between spot and futures can become self-reinforcing narratives online, especially in retail communities. But from a structural standpoint, the current differences are within normal historical ranges. There is no clear sign of exchange dysfunction. There is no confirmed evidence of settlement stress. Warehouse inventory levels on major exchanges remain adequate relative to open interest, though they have declined from peak levels seen in previous years. That decline has been gradual, not abrupt. So again, which silver price is right? The answer depends on your time horizon. If you are a day trader, the futures price is the one that matters because it determines margin, volatility, and intraday opportunity. If you are a long-term physical holder, the retail price, including premiums, is your real cost basis. If you are an institution hedging exposure, the spot benchmark is the primary reference. Before Wednesday's opening bell, what matters most is alignment. If spot, futures, and physical remain broadly aligned within a narrow band, the market is functioning normally. If those spreads widen sharply overnight, that signals stress, either from liquidity constraints or from aggressive directional positioning. Another key factor to watch is options expiration dynamics. Large option strikes can act like magnets for price, particularly if gamma exposure is significant. If silver is trading near a heavily populated strike level, dealers may hedge dynamically, increasing short-term volatility around that zone. Traders should also monitor Asian session flows leading into the US Open. Sometimes silver establishes its directional bias overnight in lower liquidity environments, and New York either extends or reverses that move. At the moment, volatility metrics are elevated compared to last month, but not extreme. Implied volatility suggests traders are pricing moderate movement, not a shock event. That tells us something important. The market expects movement, but not chaos. And that brings us to positioning ahead of Wednesday. Short-term momentum indicators show neutral to slightly bullish bias, but they are not overbought on higher timeframes. This gives bulls room to push higher if macro conditions cooperate. However, if yields tick up or the dollar strengthens further overnight, silver could test support levels quickly. Risk management, therefore, is critical. Heading into any open where narratives are circulating about which price is real, emotional reactions can be amplified. Professionals focus on spreads, liquidity, and confirmation rather than headlines. There's also the broader context of investor flows into precious metals ETFs. Recent data indicates steady but not explosive inflows that supports the idea of gradual accumulation rather than speculative mania. In summary, before Wednesday's silver opening, the market structure appears stable but tense. There are multiple prices because silver trades across multiple mechanisms. The differences are not abnormal, but they are enough to create debate. The real test will come at the open. Does price break above resistance with expanding volume, confirming bullish continuation? Or does it fail at the top of the range and rotate lower, reinforcing consolidation? Let's now drill into the mechanics that will likely shape Wednesday's opening tone, starting with futures structure in more detail. Open interest in silver futures has been climbing steadily over the past several sessions. Rising open interest alongside stable to rising prices typically indicates fresh long positions entering the market rather than short covering alone. That distinction matters. Short covering rallies can be sharp but brief. New long positioning, if sustained, can build a stronger foundation. However, context is critical. If open interest rises while price stalls near resistance, that may indicate new shorts stepping in as well. In that case, the market becomes a compression coil. The longer it coils, the more decisive the eventual breakout tends to be. Another important metric is the ratio between registered and eligible inventories in exchange warehouses. Registered silver represents metal available for delivery against futures contracts. Eligible silver meets standards but is not necessarily committed for delivery. While total inventories remain sufficient relative to immediate delivery needs, the gradual drift lower in registered stocks over time has been noted by market participants. Does that automatically imply a shortage? No, but it does tighten the narrative framework. If a spike in delivery demand were to occur unexpectedly, the cushion is thinner than it once was. Heading into Wednesday, there's no sign of an acute delivery squeeze. Still, traders remain sensitive to that variable. Let's pivot to correlations. Silver's correlation with gold has remained positive, but not perfectly aligned. Gold has been supported by safe haven flows amid geopolitical uncertainty and central bank demand trends. Silver, being more industrially exposed, sometimes lags gold in risk-off moves and outperforms during growth optimism. If gold rallies strongly overnight while silver remains muted, that divergence can create catch-up trades at the open. Conversely, if gold weakens and silver has been stretched to the upside, mean reversion pressure can build quickly. The US dollar remains the pivot variable. Currency traders are watching economic releases closely. Any upside surprise in employment or inflation data can push yields higher and strengthen the dollar, weighing on silver. On the other hand, softer data can fuel rate cut expectations, which generally support metals. Before Wednesday's open, bond futures will likely provide the earliest signal. A steady treasury market suggests silver may trade technically. A sharp move in yields could override chart patterns entirely. Now, let's examine technical structure more precisely. Silver has defined a mid-range consolidation zone after its recent advance. The lower boundary of this zone has acted as support multiple times, with buyers stepping in consistently. The upper boundary has capped rallies, but has not triggered aggressive rejection volume. This pattern resembles a classic continuation setup rather than distribution. However, continuation requires confirmation. A clean break above resistance with expanding participation and follow-through into the next session would validate bullish momentum. Failure to break resistance, especially if accompanied by increasing sell volume, would suggest exhaustion. Momentum oscillators on the daily chart show neutral readings. They are neither deeply oversold nor stretched. That neutrality provides flexibility. Markets often break hardest when indicators are coiled rather than extreme. On the shorter time frames, volatility compression is visible. Intraday ranges have narrowed compared to earlier in the month. Compression typically precedes expansion, so what could trigger expansion? A macro headline, a currency spike, unexpected inventory data, or simply a technical breakout as algorithmic systems detect range violations. Algorithmic trading plays a significant role in silver futures. Many systems respond to price levels, volume spikes, and cross-asset correlations. When certain thresholds are crossed, liquidity can thin rapidly as algorithms reprice. That is why the first 30 to 60 minutes after Wednesday's opening can be particularly telling. If silver pushes through resistance quickly and holds above it, momentum funds may add exposure. If it spikes briefly and then retreats sharply, that could signal a bull trap. Let's address the retail physical market again. Premiums over spot have normalized compared to crisis peaks seen in previous years, but they remain above long-term averages. This reflects steady retail interest rather than panic buying. Coin dealers report consistent demand rather than surges. Stable retail demand can act as a slow structural support layer beneath futures markets. It does not prevent volatility, but it can cushion extended declines. Institutional flows, meanwhile, remain cautious but constructive. Exchange-traded products tracking silver have not experienced massive inflows, yet outflows have been limited as well. That balance suggests investors are not fleeing the sector. Another angle to watch is the gold-silver ratio. The ratio has tightened slightly from recent highs, indicating silver has modestly outperformed gold. Historically, when the ratio compresses from elevated levels, it can signal improving risk appetite within the precious metals complex. If that compression continues, silver may attract relative value traders betting on further narrowing. However, if the ratio reverses sharply higher, it may indicate defensive positioning returning to gold over silver. Before Wednesday's open, traders will also assess positioning in related markets such as copper. Copper strength can sometimes signal industrial optimism that spills into silver. Weakness in base metals, on the other hand, can temper enthusiasm. Energy markets matter as well. Oil price movements influence inflation expectations and broader commodity sentiment. A sharp move in crude overnight can shape macro flows that indirectly impact silver. So far, cross-asset signals remain mixed rather than extreme. Let's consider risk scenarios. Bullish scenario. Silver breaks above its established resistance band early in the session, volume expands meaningfully, the dollar softens, and bond yields stabilize or decline. In that case, momentum could carry price toward the next technical target zone quickly. Neutral scenario. Silver oscillates within the established range, fading early moves with low conviction on both sides. That would reinforce consolidation and delay resolution. Bearish scenario. Silver attempts a breakout, fails, and reverses sharply as yields rise or the dollar strengthens. If support breaks decisively, stops may cascade, accelerating downside toward lower retracement levels. Professional traders are not asking which single price is real. They are asking which flows are dominant. Is the dominant flow hedging, speculation, industrial procurement, ETF allocation, currency hedging? The answer heading into Wednesday appears balanced but slightly tilted toward tactical optimism. There is interest in upside continuation, but conviction is not overwhelming. This creates a market where small catalysts can have outsized impact. It is also important to emphasize that silver's volatility profile is historically higher than gold's. Silver tends to move in larger percentage swings due to its thinner liquidity and dual industrial monetary nature. That means even modest macro shifts can produce noticeable price adjustments. For those trading Wednesday's open, clarity on time horizon is essential. Intraday volatility can differ dramatically from weekly structure. A sharp move in the first hour does not necessarily define the weekly trend. Another subtle but important point involves liquidity depth. Order book depth during overnight sessions is thinner than during peak New York hours. If a directional move begins in Asia or Europe, it can appear exaggerated. When New York opens and liquidity thickens, price sometimes retraces part of that move. So when evaluating which silver price is right, context matters not just across platforms, but across time zones. Before Wednesday's opening bell, the core takeaway is this. The silver market is not broken. It is complex. Multiple prices reflect multiple functions. The alignment between spot and futures remains within historical norms. Physical premiums indicate steady demand but not panic. Positioning is elevated but not extreme. Volatility is compressed but not dormant. As we approach Wednesday's silver opening, preparation becomes more important than prediction. Markets reward structure, not emotion. So, in this final segment, let's outline the concrete levels, catalysts, and behavioral signals that will likely define the next session. First, key technical levels. The immediate resistance zone sits just above the recent consolidation ceiling that has capped advances multiple times. A sustained move above that band, especially on expanding volume during New York hours, would represent a structural shift from range-bound trade to potential trend continuation. Traders will look for not just a breakout, but a hold above that level for at least 1 to 2 hourly closes. On the downside, the established support floor remains critical. That zone has absorbed selling pressure repeatedly. If price tested again and buyers defend it with strong reaction volume, the range remains intact. However, if that support gives way decisively, particularly with rising open interest, the probability of a deeper retracement increases. Now let's connect this to futures behavior at the open. Watch the first 15 minutes carefully. Is there aggressive market buying lifting offers immediately? Or does price spike and then fade as sellers step in? Often, the tone of the first hour sets the narrative tone for the day, even if the direction ultimately changes later. Also, monitor spreads between front month and next month contracts. If contango widens unexpectedly, it could signal changes in short-term financing or hedging behavior. If backwardation appears, even briefly, it tends to attract rapid attention because it suggests immediate demand pressure relative to future supply. Turning to macro catalysts within the next 24 hours, traders are focused on economic releases tied to inflation expectations, labor conditions, and growth momentum. Even second-tier data can matter in a market currently coiled within a tight range. Bond yields will likely be the earliest tell. If 10-year yields drift lower overnight, silver may open with tailwinds. If yields push higher into the open, metals could face initial pressure. It is not the headline alone that matters, but the market reaction to it. Currency markets are equally important. A sudden strengthening in the US dollar during pre-market hours could weigh on silver before equities even begin trading. Conversely, dollar softness could provide early momentum for metals. Another variable to monitor is volatility itself. Implied volatility in silver options has risen moderately compared to recent baselines, but remains below crisis thresholds. If implied volatility begins expanding sharply ahead of price movement, it can signal positioning adjustments before directional commitment becomes obvious. Options positioning around major strike levels can act like gravity wells. If silver is trading near a heavily concentrated strike, dealers hedging gamma exposure may dampen volatility as price approaches that level, only to release pent-up movement once it breaks decisively beyond it. This dynamic can create the illusion of artificial suppression or sudden explosion. In reality, it is mechanical hedging behavior. Let's address sentiment briefly. Online retail forums often amplify narratives of real price versus fake price. While these discussions can influence short-term flows at the margin, institutional pricing mechanisms remain anchored to deep liquidity pools. Temporary discrepancies can occur, but sustained structural divergence requires actual supply-demand imbalance. At this stage, there is no verified evidence of structural dysfunction. The market is debating direction, not survival. From a strategic perspective, patience is often underrated. When markets compress into ranges, traders feel pressure to anticipate the breakout, but confirmation carries value. Entering after confirmation may reduce reward potential slightly, but it also reduces the probability of false breakouts. Risk management into Wednesday's open should account for silver's historical tendency toward intraday whipsaws. Stops placed too tightly within a compression zone are often triggered before the true move develops. Now consider the broader weekly context. If silver closes Wednesday above its range high, that sets up a technically constructive weekly pattern. If it closes back inside the range after probing higher, it reinforces consolidation. Weekly structure often carries more weight than intraday noise. Let's also examine the role of global flows. Asian market participants sometimes express demand through physical channels more than futures. European participants often engage via both OTC and exchange-traded products. US participants dominate COMEX futures volume. The interplay between these regions can create staggered momentum. If Asia bids silver overnight and Europe extends that bid, New York traders may either chase or fade depending on macro overlays. Observing how each region responds to price levels provides insight into conviction. Another subtle signal involves silver mining equities. While not a perfect proxy, strong performance in major silver producers relative to the metal itself can indicate forward-looking optimism. If miners lag significantly despite metal strength, caution may be warranted. Heading into Wednesday, mining shares have shown mixed performance, suggesting investors are waiting for confirmation from the metal itself. Now let's revisit the central question: which silver price is right? The correct answer is that price is contextual. The futures price determines leveraged exposure. The spot benchmark anchors global valuation. The physical retail price reflects fabrication and distribution realities. None are inherently wrong. They serve different functions. What matters most before the open is convergence behavior. If price mechanisms remain tightly coupled, the market is orderly. If they begin drifting apart rapidly without clear catalysts, volatility risk increases. At this moment, silver appears balanced between competing forces. On one side, supportive elements include steady retail demand, manageable inventories, and the possibility of softer macro data boosting rate cut expectations. On the other side, headwinds include a firm dollar, cautious institutional flows, and technical resistance just overhead. This tension is not a flaw. It is the nature of transitional markets. As traders prepare for Wednesday, the objective should not be certainty. It should be readiness. Readiness to respond to breakout confirmation. Readiness to step aside if conditions remain indecisive. Readiness to protect capital if volatility expands unexpectedly. The coming session may resolve the current range, or it may extend consolidation further. Either outcome provides information. In the end, markets reveal truth through reaction, not prediction. When Wednesday's silver opening bell rings, watch liquidity, watch volume, watch correlation with yields in the dollar. Let price prove itself before committing emotionally to a narrative. Because in complex markets like silver, the right price is not the one displayed on your screen at a single moment. The right price is the one validated by participation, confirmed by structure, and sustained by flow. Thanks for watching.